Welcome to Barchart's series of educational webinars designed to enlighten you about a variety of investment ideas and concepts, to inform you of the features and pages related to these concepts, and offer you some trader's insight to help you make a more informed investment decision. Today's session, LEAPS Options Made Simple, a beginner's guide to long-term investing. Long-term equity anticipation securities, or LEAPS, are similar to conventional short-term options. They're priced the same, their mechanics and specifications are the same, they expire the same. But the main difference is time and time to expiration. Time favors the purchaser of options, and why LEAPS are popular among long-term investors. Yet, because of time, LEAPS pricing is influenced by variables that short-term options traders might not consider. And also because of time, LEAPS prices are more expensive than our short-term options. But price is what you pay for, and time is a valuable commodity. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategist. Oops, there we go. Oh, man, having a lot of difficulties today. Hang on. Wake up, computer. There we go. There I am. Some days. So as I said, I'm Barchart's market strategist. And today's session, we're going to kind of just do an introductory class to give you a jumping off point to understanding what, why, how, and when the abouts of LEAPS. We're going to look at a combination of pricing factors that influence LEAPS and how they compare to their short-term cousin. Now, before we get to that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean.
Good afternoon, John, and your runaway PowerPoint presentation.
Yeah, exactly. I know Jean's has a little bit of a frog in her throat, so let's just leap into it, Jean, okay?
That sounds good to me, thanks.
All right, cheers. All right, just a reminder that today's session is for educational purposes only, and decisions to buy, sell, or hold or trade securities, commodities, or any other investments involved risk and are best made on the advice of a qualified financial professional. I will add that options trading is not for everyone and can result in a loss of principal. And under no circumstances shall we be liable for any losses or damages that you or anyone else incurs as a result of trading or investment activity that you or anyone else engages in based on the information or material you receive through Barchart.com and our services. Okay. So, right, long-term equity anticipation securities, LEAPS, right? So they're no different than regular options or our conventional short-term options. The only main difference is, or that exception is, that the length of time that these options have. Now, long-term LEAPS or LEAPS, long-term options, are generally listed at about 2.5 years before they expire. What I'm saying here is that this upcoming quarter, we'll start seeing LEAPS that are become available to trade that will be something like the January 27 LEAPS. It'll just be available for us to start trading. Now, LEAPS are options whose expiration dates are just longer than 1 year, and there are many different opportunities to trade options outside of 1 year. Now, about a third of stocks have LEAP options. Now, in recent years, we've seen more and more stocks offer LEAP options. But what you'll find is that they're more commonly found in ETFs and options, index options, as well as in some more popular traded securities. So I'm just going to go to, first of all, let's go to Apple, and I'm on the Apple main page. And what I want to kind of show you is on any of the securities that trade options, what you can do is to discover if they do have leaps or how far they go out, just go to the put call ratio page under the options menu. And what you're going to see is all the different option expiries. In other words, all those different options that expire at different time frames. And you can see how far out those options are by something called the DTE, or days until expiration. So you can see for Apple, we do have one that is about a year out, 2 years, and about 2 years plus. Again, what I said is that in indexes and ETFs, you might discover that you have some more so-called options. Again, I'm just going to go to my put call ratio page, and here's the S&P index, right, that trades options. And you can see that in this case, we have options that go out almost 2,000 days, right, all the way out into December 21, 29, right? Something that is more unique to indexes. But when we start to look at LEAP options as a trader or an investor, one of the things that we need to discover or look at is we want to make sure that there is enough volume and also open interest to support the activity of these leaps. In other words, I don't want to trade a leap where there is not a lot of open interest or volume, because what will happen is that the bid ask will get very wide, or that there might not be market makers that are supporting that particular market. So you can see here for the indexes here, yeah, maybe on today there's not a lot of individual volume, but you can see out to December 25th, there is some volume today. But notice, look at the open interest. So that means market makers are supporting this market. If I go to, let's say, a common stock like Alcoa, and I just pick Alcoa because it's AA, but it is a commonly traded stock, and I look at, yeah, there is one or two LEAP options that I can trade, 380 days, 590 days. But notice that the one that is only 1 year out in the future right now does not have a lot of open interest, does not have a lot of daily volume. So it's not really supported by market makers. Doesn't mean I can't trade these, it just means that I'll be aware that my bid-ask spreads will be very wide, where I can see this LEAP has a lot more open interest. It tells me market makers are more likely to be involved in that LEAP than So important fact is when we start looking at different LEAPs, make sure that you have volume and open interest. So the pricing factors, or the factors for all options, is the same regardless of short term or long term. The biggest difference for LEAPS is the effect of volatility, risk-free interest rates, and dividends. Now we're going to dive a little bit deeper into this in just a moment. So option strategies involving LEAPS are going to be similar to the same option strategies that you see for short terms. Again, variables like time and also the individual's goal might favor buyers of LEAPS. But time is a large component to LEAPS. So as a buyer of LEAPS, you might think that you are getting away with something. You might discover that, hey, you might think that LEAPS are cheap, but I will let you know that our market makers do the best to price LEAPS in the favor of them. But they can't price the unexpected, right? They can't price what they don't know is going to happen. So again, you will see narrow bids and asks on more actively traded ones, but again, as we go out in time, you might see wider bid ask. But here's what I'm kind of saying in that scenario of you might think that you found something that is valuable or cheap. So let's go to volatility and Greeks under our options. Now I've jumped to the S&P SPY F ETF, and let's go out to 3 months. And I'm looking at the September expiry, and this is about 3 months or about 107 days out. And I want to show you that here I'm looking at the at the money call, and you can see the at the money call is around $19.65. Well, let's go out, 2 years into the future in terms of our options. So now we're looking at the June 2026 option, which is about 2 years in the future. And we're looking at the same at the money calls strike price. And here you can see that the cost is about $72.60. So, you might think that you're getting a discount here, right? Because how many 3-month periods there are in the next 2 years? Well, there's 8 times as much more time in this 2-year leap, but the cost is only about 4 times the leap, less than 4 times the leap. So you might think that these leaps are cheap because of that value of time. And this is an important concept in leaps, that time is not linear, right? And that there you can price leaps cheaper in the future, and that you might actually be able to buy more time for a little bit extra about amount of costs. So when it comes down to option strategies, right? And we're making this distinction between leaps and short-term option strategies. The strategies are all basically the same. And when we think about option strategies, it really comes down to how are those options priced. In other words, if they're fairly priced or we're in a low volatility IV environment, then you're probably going to be leaning towards option strategies where you want to buy options. Now, if options are expensive or we're in a high implied volatility environment, then we're probably going to lean towards those strategies that where we want to sell options. It's no different between short-term and leaps. It ultimately comes down to how are options priced and how do we view them. Are they being priced fairly, cheap, or are they expensive? So let's kind of remind ourselves of what are the factors that influence option pricing. So there are 6 factors, right? The underlying stock price, the strike price, the time remaining, our DTE, volatility, risk-free interest rates, and dividend rate. Now, when we look at short-term options, we'll see that a lot of the factors that influence short-term options are more likely going to be, where is the price of the stock? Where is my strike price? And how much time or theta decay did I have on that options? Those things are being a little bit more influenced on our short-term options. When we start thinking about leaps, well, then volatility, risk-free interest rates, and dividend rates are more influencing on LEAPS. They give us more an effect on the pricing of LEAPS. Now let's talk about these 3: volatility, risk-free interest rates, and dividends. Now volatility is just another way can be expressed in our Greeks as called vega. And the basic understanding that I want you to take away is because of more time, leaps, then our vegas are going to be larger. So let's look at that. So again, I'm back in my SPY. Here's my volatility in Greeks. And again, I'm looking at that June 26 option. And you can see here our vega, which is our sensitivity to a change in volatility. You can see that our vega for our at the money call is 2.66, or in other words, $2.66. That means for every 1% change in implied volatility, this option will change by $2.66. If we go back to that September, that three-month option, notice that our vega, our sensitivity to changes in volatility, is a lot less. It's about half of what we see in our longer term. But this makes sense, right? Because there's less time for some unexpected event to happen that could change volatility. And that's why we see a lower vega number. So volatility. So if you asked me about volatility, I would say it's probably the second most important factor next to, the price of your underlying stock. But changes in volatility do influence all options. But small changes in volatility can have a huge impact on our leaps. And again, the theory behind pricing that the longer the term the option always has a higher vega, or in other words, a higher sensitivity to volatility when compared to options of less time. So a rise in volatility will be beneficial to those leaps that were purchased, or long leaps, be it puts or calls, even if the price of the underlying is unfavorable. So let me kind of reword this for you. Let's say I buy a leap call and the stock price falls, let's say, by $5. I'm just making this up. But during that $5 price sell-off, the volatility, let's say, goes up 2%. Well, my leap might actually benefit in price because of the increase in volatility, and the fall of price might not be as large, or the increase in volatility effect on leap prices might be enough to counteract the fall of price. So rising volatility is beneficial for those who own leaps, both calls and puts. So it's critical to assess volatility on a historical level as well before we start using leaps in any trading idea or trading option strategy. Now, I don't want you to get confused here on the term historical, because we do use that in terms of identifying volatility. So let's go back to, I'm getting back on the SPY page, and I want to go to price overview. This is the main page. And just below here, about midway down, you can see where it says options overview. And you do have some metrics to look at options volatility. We have our implied volatility, our historical, our percentiles, and our ranks. And then also, what is the high implied volatility and the low implied volatility? But let's go inside the details, right? Devil's always inside the details. So the implied volatility that we see on this page is representative of the monthly nearby monthly contract that is 30 days out or more. In other words, that first monthly expiration that is out 30 days. The historical that we're looking at this page is reflective of the average over the last 20 days. Again, these might be applicable for an LEAP assessment. We have our implied volatility percentiles and ranks, and these are based on over the last prior year. But again, these are where our current implied volatilities rank over the last year. But we do have our high and low. What is the highest IV reading and what is the lowest? So let's go back to our LEAPS, and I'm going to go to volatility and Greeks, and let's look at that, the farthest out LEAP we can go, and this one is out 926 days. And notice what happens here is what we get is the implied volatility that is specific to this expiry. In other words, this LEAP. And we also, based on the volatility in Greek's page, we can see what the volatility is that is unique to each of the individual strikes that we might be considering. So in the case of what we see today, the 350, the 530 at the money call has an implied volatility of 16.88. Again, let's go back to our pricing page of our S&P, and what we see here is, again, look at the implied volatility of the shorter term options. It's only about 11%. But where does 16.8 rank inside of our high and low? And we can see that the high was 19.2. So our implied volatility for our LEAPS is much higher. In other words, when we start assessing pricing, high volatility usually relates to higher options prices. Low volatility relates to lower pricing. So in that sense, what I might be thinking about is those strategies, because we have a higher volatility, that might look to sell LEAPS and not necessarily buy LEAPS. But again, this is really just kind of a historical analysis. I just want to make sure where my LEAPS. Now, in general, again, the volatility will be greater for LEAPS because what? There's more time. So the other two pricing factors that we have to take in consideration with LEAPS are interest rates and dividends. So rising interest rates increase the cost of capital, and that increases the price of calls and decreases the price of puts. Now, why does this happen? Well, the market maker who sells a call, sells a LEAP call to us, right? They have to hedge that position. So in order for them to hedge that position, they usually buy stock. Now, that is a cost to them, a cost to carry that stock. And so call prices have to be high enough for them to offset that risk. So falling interest rates have the opposite effect. So it decreases the value of calls and increases the value of puts. Again, so let's think about strategies. Currently, we're in a relatively high rate environment. That meaning that calls are relatively expensive and puts are relatively cheap. So if I'm going to do some kind of option strategy using LEAPS, I need to understand this concept. Now, again, and my strategy might be depend on where I think prices are going to go, where I believe interest rates are go. So if I think that interest rates are going to fall over the next 2 years, then I don't want to buy LEAPS, right? I probably want to buy puts. Or if I believe the interest rates are going to go higher, and I believe my stock price is going to go higher, then yeah, maybe I want to buy LEAPS as well. Again, this concept of how does interest rates affect our pricing and how that falls into a option strategy. So buying call LEAPS can be a substitute to ownership of the underlying. And what we would look at is investing the cash that is not invested in the individual stock or ETF and investing that into a CD or a T-bill. And this could be very beneficial. Now, the benefit is that the downside risk is limited to the option that we buy, but we have to do some kind of comparison. We have to make sure that this is worth it. So first thing that we have to understand is we're going to look at that loss of dividend that I would have received if I would have bought the stock, and how much gain in price of the stock do I give up in terms of the premium that I have to pay. Now I'm going to offset that or compare that to the gain in the interest payment that I'm going to receive based on the monies that I didn't invest in the stock. So let me kind of give you an example. So let's say we look at the S&P or the SPY right now. Today it's trading around 530. So if I wanted to buy 100 shares of the SPY, $530 times 100, that would be $53,000. That's how much I would have to put to invest. Now, during the next 2 years, I'm also going to get a dividend, and I'm going to show you how to find that in a second. But the dividend for the S&P is about $6.70. So I know that over 2 years, how much I'm going to receive in terms of a dividend. Now what I could do is say, all right, let's go and buy a LEAP. And let's say I'm going to buy a LEAP that's, let's say, 2 years out. Well, a 2-year LEAP this morning was trading around $80. In other words, $8,000 for one LEAP. So if I, instead of spending $53,000 to buy the S&P for 100 shares, I could buy one LEAP for $8,000 and still control what would be 100 shares of the S&P, the SPY. But I had saved myself $43,000 in cash. So I could take that $43,000 and invest it in a T-bill or a CD during the length of the time of that LEAP. So let's just assume 5%. So $43,000 on a 5% T-bill or CD, that would be about $22.50. So what I want to do is I want to look at how much dividend I'm giving up versus the interest payment that I'm going to get from that cash that I'm going to put. Now, the last piece of the puzzle is how much premium I'm paying for time, that extrinsic value. So it's really easy. If you buy an out of the money call, then all of that is that time premium. If you're buying an in the money call, then that time premium is that intrinsic, that how much is that call in the money minus the price of that call. So you add up the dividend you would receive and that time premium, and you compare it to the T-bill rate that you're going to receive. And if they're compatible, then it's more advantageous to own a LEAP and invest your money in a T-bill, limiting that risk to the downside. But if it's more, then it's probably more advantageous to own the stock and receive the dividends. Now, currently, if we look at some more of those extreme long-term LEAPS, those that are about 2 years or longer, it's not beneficial right now. to own LEAPS and substitute for ownership. But if you were looking at, say, some 1-year LEAPS, and these numbers start to make sense, especially in growth stocks, those that have little or no dividends. So we'll do a webinar sometime in the future where we'll go a little bit more in depth in this idea, but I just wanted to propose the idea that buying LEAPS is a good substitute for ownership of a stock. So dividends can have an effect on LEAPS as well. There is an inverse effect on pricing. So rising dividends, puts become more expensive, and calls decrease in volume. Now, this is just a reflection of the dividend payout in the absolute price of the underlying. So if you're not familiar with how dividends affect the price of options, let's for say I have a $50 stock, and that stock declares a dividend, and it goes ex-dividend, in other words, pays that dividend, let's say $1 dividend. Well, on that day it goes ex-dividends, the price of the stock will fall to $49. Now, you didn't lose money, right? The stock is $49, but you still have that dollar dividend. That is reflective in the dividend and the underlying price. So when we look at LEAPS, understand that every time a dividend is paid, that will have an effect on LEAPS. And because we have LEAPS for years or many quarters when dividends are paid, you're going to have multiple times where your LEAP will be affected by the dividend payout. So it's essential to understand where dividends are or how that total dividend payout is going to affect your LEAPS. And also, we need to understand this consistency of dividends or dividend increases. So again, I'm back on the main page of the SPY, and just right here, you can see where I have my payout for my annual dividend. So you can see the dividend yield for the S&P SPY ETF is $6.72. Now, if I click on this more button here, what it will take me to is the key statistics menu page, which you can find under the company in your drop down in your menu. And you can see the dividend payouts over either quarterly, semi-annually, or annually, in this case, quarterly. And you can see, is there a consistent dividend payout, and has it increased over time? And we can see for the SPY that it does. So again, thinking about pricing of LEAPS, if I buy a call LEAP, and I need to understand that over the life of that option, that this consistency of paying out and also increasing dividend will affect that price. Now, I will do a point out here is, and this could be a timing thing that you could do, is notice how the December payouts for ETFs is always the highest for the year. Now, remember, in this SPY, we're talking about 500 shares of 500 different stocks, and they all have different times that they pay out. Some of them during the corporate years are different. Maybe they pay out early in November or December. And so what the ETF does is collects all those dividends, and then at the end of the year, it pays it out. Usually it's at the third Friday or third Wednesday of the month. And you can see that it's usually the highest. So knowing that call options, LEAP call options, fall in value with dividend payouts, you could use this as a timing effect. In other words, if you were looking to purchase options, LEAP options, maybe you wait for when the dividend payouts occur. All right, so let's talk about deltas here briefly, and because deltas are a really important part about doing assessments of a lot of trading strategies, or at least options trading strategy. And so again, if you're new to the whole options world, delta is just tells us, it's a Greek that tells us how sensitive an options are to the change in price of the underlying security. So at the money call leaps, deltas are larger than their comparable short-term options. Again, I'm just going to go back to my Greeks and volatility, and let's go to the farthest leap we can find. Here we are at the money, and you can see the delta for the at the money is 0.687. So what does that represent? Well, that tells us that for every dollar change in the price of this ETF, the option is going to change by 0.868 or 68 cents. If I look at that shorter term 3-month option, notice my delta at the money is a little bit less. Now, why is this kind of important? Well, first of all, in the money options, about 5% into the money, leaps and short-term options are about equal. But the deeper we get into the money, we'll find that comparable lower leap deltas. Now, I'm not saying that the delta is going to go down the more you go in the money. I'm just saying that the relationship of in the money deltas versus leaps and shorter terms are going to favor shorter terms. So if you think a stock is going to move in a short period of time, it's more advantageous to be trading short-term options. Leap options deltas are more consistent, more stable, right? They don't move as much with the volatility of the underlying. So let's go back to our leaps. Again, our longer term leap. And I'm looking at, again, that 68 delta at the money. And if I go into these 3 dots here, this is called links. And I could look at price history. And this is what I'm kind of pointing out to you. Notice that the delta here for the at the money, right, the 530 call that expires in 926 days, notice how the delta is very stable. It doesn't really move around much as the stock price moves around. And this is beneficial for us in a couple ways. First of all, we know that our prices are going to be relatively stable, but also large price movements will also be dampened a bit to it, which could be a benefit or it could be negative to us. So let's go back and look at the shorter term options delta during the same time period. And again, we're looking at the 530 history. We're going to go to history. And again, notice we can see that our delta moves around a lot, right? So a little bit more volatile in terms of that relationship to the change in price of our stock and the change in price of our option. So this stability is a positive for buyers because we can anticipate how much that option is going to increase or decrease based on how much our stock is going to move. So LEAP puts really have an inverse relationship to the underlying security. Again, as as prices go up, calls will appreciate. As prices go up, puts will decrease, and vice versa. As prices go down, calls will get cheaper, but as prices go down of the underlying, then our LEAPS will put LEAPS will increase. Now, short-term puts will move a lot more faster than LEAPS. That stability that we see in LEAPS. But LEAP put buyers, that leverage that you get from buying an option will be dampened with downside price action of the underlying. So what do I mean by this? So again, let's go back to our longer term LEAP. And now I'm on the put side here. Notice that our delta is different from our call side. Matter of fact, it's significantly different. So those are familiar with deltas knows that like short-term deltas options you'll see that the puts and calls will be relatively close, will be very close to that 50% or 50 cents. Here you can see there's a lot more difference. In other words, that puts are less sensitive to price movement of delta's price movements to the underlying. And again, if you are buying a put on a speculative and you're thinking that prices of the stock are going to fall over the next, let's say, year or so, you notice that you're not getting that leverage that you would have gotten if, for instance, you bought a call LEAP and the price of the stock rises. So that would be a detriment if you were speculating on a downside price. But let's think about, we talked about time as our benefit. Time is beneficial to the buyer. If we're buying puts as an insurance policy to downside price action, that I know that even if the price of the stock goes up for puts, I'm not going to get as much of a price depreciation in my put. So that is actually kind of beneficial, isn't it? So put buyers, their leverage is less, it's dampened by price action, but this actually might be a benefit to the put buyer because if the price of the stock goes up, they're not going to lose as much value in their put as a call LEAP buyer would lose if the price of the underlying fell. All right, so I do have some takeaways. Where are we at here on time? Let's see. I think we're right on time. Yep, on schedule. So we do have some questions that I see. So I want to see if I can answer some of these questions. And again, if I don't answer all your questions, I apologize. Or just be realized that today's session is really for at the beginner level. I know that maybe some of these questions might be a little bit more detailed or kind of a little more advanced. So we will do advanced LEAP webinar sometime in the near future. I don't know exactly when, but we'll look for that. But again, you can send your questions to support@barchart.com and we'll have somebody help answer that question for you. So Marco asked a really good question about what is a good threshold for open interest at volume to consider on options. Now, again, Marco, I think in terms of longer term LEAPS, you're going to lower that threshold. That just kind of makes sense. But I think you could do a comparison of the options that are being traded for that particular for that particular stock, for instance. So again, let me go to that put call ratio. Right. I mean, you can see that there's a lot of volume and open interest in our shorter term options, but let's go out to the future, right? There, here you can see 100,000s, 70,000, a couple thousand traded a day in this one. So that would probably be a good threshold, maybe a couple hundred shares on a daily basis, and maybe let's say 10,000 options. If I'm looking, let's say, at an ETF, but if I'm looking at, a stock, maybe that threshold will be a little bit lower. Apple is a very actively traded stock, so maybe this is not a great example, Marco, but again, I would be more inclined to looking at, again, look at where you can see our call volume here and our put volume is for some of these, options that are way out, and also look at that ratio. If I'm not seeing any volume or just a handful of contracts trading on a regular basis, and my open interest is, let's say, again, I think it's relative to the how active that stock is. Let's say is below 10,000 or below 1,000, it's probably not a great stock or ETF to trade leaps. Okay. Um, Again, I see a lot of very specific questions on specific stocks. Again, was this kind of more of a basic. So there's a question here, if I own a Leap I don't get the dividend, that's correct, and I just suffered the drop in price. Yes. Okay. So Scott asked a really good question, like, how do you decide when a Leap is no longer beneficial for you? And I think, Scott, I think it's just, your own assessment of if you're doing a trend, right? You're deciding that, you want to buy a Leap call on based on the thought that you think the stock is going to rise over a longer period of time. How much are you going to let that stock go against you? Is it going to be 5%? Is it going to be 10%? Is it going to be 20%? Remember, you're a long-term investor, right? So, you might have a deeper threshold, right? Again, the risk is only going to be what you initially paid for, but we also talked about time is on your side. And I showed you that how deltas and um, time might still be beneficial to you, even though the stock goes down, your Leap might still hold value. So it could be a combination of both things. You could be how much does the stock fall, or let's say a percentage of your Leap. Let's say if your Leap loses 20% or your Leap loses 50%, that might be a good threshold to say, hey, you know what? You're probably wrong on um, on your stock. So let me ask you, does it pay to buy a put? Now listen, what I'm showing you is basically a concept of how leaps can change based on dividend days. But trust me, market makers are well aware of this change in pricing, right? Based on what is going to happen. And they will mark the bids and asks on that anticipation of that option. So is there an advantage to it, or do you buy the day before? Not necessarily. I'm just telling you that over the life of the contract, the option contract, how dividends might be affected by dividend payouts or options. So Jeff asked a kind of a complicated question, but let me see if I can answer it. He's asking overall VIX have to say on IV with the underlying security. In other words, he's saying is as the VIX increases, that increases the volatility of all the broader market or all options. And yeah, could that affect our leaps? It certainly could, right? A change in volatility, a percentage change in volatility would definitely have an effect on our leap prices. Now, again, in times of fear or market sentiment, when we think the prices are going to go down, we usually see volatility go up, right? That fear factor. So again, even though you own a leap call, you might actually benefit from one of those times, Jeff. All right, I've gotten through a lot of these here. So Alan asked a question about would it make sense to buy a leap and use part of it for a covered call? I don't think that would be the right sequence, Alan. I think what you're saying is, would it be advantageous to buy the stock and then sell a leap covered call? Again, that would be based on if you believe that the price is too expensive. So that really brings me to a good point here from Alan's question. Again, if I didn't get to all your questions, I apologize. So under any of our stocks or our ETFs, we can go to something called, and we've already looked at this benefit that probably we want to be buying leaps, not selling leaps, but certainly selling a cover call might be a good trade. So what I can do is under the long call and put page, I can come in here and look at my leaps. And what's nice about this here is we've talked about a lot of different metrics and input factors. And let's change this back to our SPY, since we've been kind of using that as our. Again, I'm going under the options, long call, long put. And I want to go out to our furthest leap. And what's nice about this page is it does bring forth a lot of those inputs that we want to kind of do when we do our assessment. First of all, shows us the strike, shows us the price of the underlying, with something called the BE or break even. Now the break even will be for calls will be the strike plus the ask price of the call. For the puts, it would be the strike minus the ask price for the put. And you can see that. So for instance, for today, the 5:30 strike, my break even, in other words, I would have to anticipate over the next 2 years or 2+ years that the S&P would get above 16, 14, 70. Then that leap would be become profitable. So you could do the math and figure out how much of a percent price rise that you are anticipating over the next 2 years. If that value is too large, then maybe these are too pricey of calls, or maybe you're waiting for a better opportunity. How much is that going to cost me in terms of if I buy the ask of that call? Now, moneyness is just a fancy way of saying how far we are in the money or out of the money. So green is in the money and red is out of the money. And then there's the ask of the call. Now, again, remember our bids asks are very wide, and the market maker always prices leaps in favor of the market maker. So you might be able to buy this at a little bit of a deeper discount. Maybe you try something what's called middling, where you put in a bid that is halfway between the bid and the ask, or you do your math calculations based on that principle of time premium, dividends, and interest rates, and you say, hey, I like buying this call, but I only want to spend $82 or $83. And then you just put in that price. But this is kind of a way of just dissecting the different values. Again, here is that volume. I think the question was it Jeff, I believe? Um, how do we look for volumes, right? So again, this is a very active ETF, and we can see our open interest is only about 1,500, but we did get almost 10% of volume based on the ETF. So that ETF's open interest. So that might be a better sign. Now, I will tell you this, that when you look at long calls and long puts, the basic generality you're going to find is that for calls, you're going to find a lot more action at current price and in the money calls. And when we look at puts, you're going to see a lot more action at the money and out the money puts. So it's a little bit different there. But then again, there's our RV rank that is unique to our strike and our expiry. And then there's that delta. These last two ones are probability of that option is going to finish in the money. Again, probability might be how much I'm willing to pay versus the risk reward ratio of where my break even is. So that's long calls. Again, look at long puts. Notice how our moneyness flips here now, right? Out of the money, in the money. And again, notice how our prices for our puts are a lot cheaper for our leaps, again, because of that muted effect of our less delta. So again, maybe more advantageous to buy puts as an insurance policy. And notice that if we look at our open interest and our price volume activity, notice how a lot more of it in the puts is out of the money, right? Again, more of an insurance policy that I'm going to take over a longer period of time. Okay. All right, so let's do this because we are at the top of the hour and I didn't want to take that much time, but so here's some takeaways for you. LEAPS are long-term options that adhere to the same option strategies as short terms, right? Options. The main difference is the effect of time, interest rates, and dividends have on LEAP pricings. Buyers of LEAP calls offers a flexible alternative to ownership of that stock, empowering you to invest that excess cash in interest rate securities. Again, the assessment that you're going to look at is the time premium you purchase versus plus the dividend that you're foregoing versus the dividend interest received. Buying LEAPS puts can act as an insurance policy against market declines. And so this is a great way to buy insurance that you can hold on for a longer period of time instead of buying just puts like every 3 months or every 6 months. And that can be very, very expensive in the long run. So you might benefit even though you're paying for a little bit more upfront, but because you're getting a much longer period of time, that insurance that will protect you. And then finally, again, that LEAPS have a low rate of decay. In other words, that theta or that time decay. Remember that our pricing is not linear and that our deltas are relatively stable, right? Our price can move around and the change of our option is probably going to be, quite consistent, and which makes for buyers of LEAPS will come to appreciate over a longer period of time. Okay. So I hope you guys enjoyed today's session. Again, I wanted this to be a little bit more on the basic side, and I hope that you don't feel like you wasted your time if you were looking for some advanced details. And I do see a lot of questions of some of our regulars. I apologize I didn't get to them. Again, send those to support@barchart.com and we'll get those answered for you. Okay. Just to remind you that next week we're going to do a webinar on Fibonacci's, and we're going to use this more not as a strategy, but how can we use Fibonacci's to identify areas where we find other technical analysis. In other words, confirming that technical analysis. So, deciphering trading opportunities based on this ideal of looking for clusters of evidence in terms of our trading decisions. So I hope you come and check that one out. The other thing I want to remind you folks is that a lot of the option stuff that we do on our webpage, you need to be a plus or premium member to get to some of the levels that I demonstrated. So we do offer a free 30-day trial for our Premier and Plus. And I talk about an option that is risk-free. You could try those out for 30 days. So again, I give that a shot if you're not a Premier member, okay? Until next time, be safe out there, manage your risk, and the good of all trading.